C, or the work on stage C is basically what everybody is looking forward to. From an economic perspective, this is where we're saying, what is the impact from rising unemployment, business closing, corporate failures, and credit defaults, and so on and so forth, right? And everything that is linked to kind of the corporate life or the economic side of it. And here the priorities would be first to support people and businesses affected by the lockdown. And we've seen a lot of the packages that we just discussed go specifically on this. The second point on this is basically to prepare to get back to work safely when the virus subsides. We're seeing this already starting to happen. We're seeing at least most of the economy starting to put a plan to go back to work. We're seeing it in the GCC a bit with maybe a shyer effort than other places, but we're seeing it in Europe and in the UK and so on. And I think what some corporates are starting to think about is that, how to recover from this, and also on a country level, policymakers are thinking what is the way forward. I mean, in Dubai, we've seen article in the FT a couple of days back, but we've seen also some of the policymakers or talking about the vision of the whole country is going to change post-COVID, and maybe the way things will run are going to be different, or the aspirations are going to be different on different dimensions. So basically, what this tells us is that there will be long-term implications across both dimensions. And if we boil down these two dimensions into developing different scenarios, we come up with what we tabled here on, the expected kind of outcomes from an economic perspective. So to help you read this page quickly, so what you have on the left-hand side is the first dimension, which is the virus spread and public health response. And here you have, how proactive or not the different governments are on this front. On the second dimension, it's basically the knock-on effect on the economic policy response. So we've put together these scenarios, and we run a global survey with over 2,000 executives, out of which 200 are from the MENA region. And the message from this, or at least what we come out from the MENA, is that we see a bit more optimism in the MENA region than globally. Where do I see this in the slide is basically, if you look at the scenarios A1 and A3, which if you look at the numbers, the 16, for example, on A3, the 16% is how many of the global executives thought we will be in a scenario A3, versus in the Middle East or in the MENA region, it was 26%. Scenario A1, 31% of global kind of respondents said we think we're going to be in scenario A1, versus 23 in the Middle East. So this is what we mean, is that you have more on the more optimistic scenario, which is A3 than A1. But these are the two scenarios that we believe are the most probable scenarios, or at least up until 10 days ago, this was the view in terms of scenarios. So these are the two that we'll go a bit more into describing them. So what does it mean what does scenario A3 mean, or scenario A1 mean? So A3, we tried to kind of to put it in words, is basically virus contained. So we're talking here, if I just go back to the table, we're talking about the rapid and effective control of the virus spread, right? With partial effective intervention from governments from an economic perspective. So here we're saying this means that by mid Q2 we contained the spread of the virus. So we're talking about literally within these days. So maybe we've already the boat has already passed for this scenario, but let's see. And the lockdown is limited to 2 months. This potentially, depending on how you interpret the lockdown, full lockdown, and semi-lockdown, and so on, might be something that what we're going through. But if you look at it from an overall mobility perspective, transportation, all airports are still closed, most of the world at least. we can, by any measure, we cannot say that the lockdown has been lifted in any of the major economies. I think we're still within that. In terms of impact on GDP, global GDP, this is potentially about 2.7%. Again, these are estimates to be taken as guidance rather than the number itself. And potential time to recovery would be Q1 2021. Again, this is on a global level, but we will show later on how does this translate across the world and what does it mean for different sectors. And that assumes kind of oil price of about $30 per barrel. A muted recovery, on the other hand, is basically again, let me just go back to the previous page. It's basically we're talking about effective response, but the virus is a recurrence. There's recurrence of the virus. So this is what we hear a lot about, having multiple peaks potentially. And from a policy, it's a partially effective intervention. Here, this translates into potentially a 4-month lockdown, about 6.5% drop in GDP, and recovery. Global GDP recovery delayed until Q3 2022, and this corresponds to a potential oil price of $25 per barrel, given the slower economic pace globally. So, if we look at the impact on GCC countries, we believe that this crisis will have a higher impact than what we've seen in the financial crisis of 2008-2009, where, for example, in Saudi, we've seen a drop of 2% in GDP, in UAE 5%, Kuwait 7%, while in Qatar we haven't seen a big drop. Under the two scenarios of A3 and A1, we see the drop in a multiple of magnitude. So we're saying about, Saudi could be anywhere between -5 to -9% drop in GDP. And if you see the small circles next to it in terms of time to recovery, it's about 3 to 4 years. And similarly, if we look at the UAE, we're talking about 5 to 8%, Kuwait 5 to 7%, and Qatar. In this scenario, we're expecting also to see an impact versus what was the case in 2008, 2009, which was unaffected, and Qatar was still growing very fast. So this is overall, if you look at it from overall economy. And to put this in perspective from a global point of view, how do these scenarios translate globally, right? When we mentioned for the world, we're talking about a drop of about 2.7 to 6.5%, depending on these two scenarios. And just keep in mind that these are two scenarios that we've picked, and we believe from the survey that they are the most probable scenarios, but they are by no means the only two scenarios, right? We've seen potentially better scenarios and potentially worse scenarios. But just keep that also in mind. If you look at here in terms of potential impact in the US, in the Eurozone, I think with the different scenarios, the impact becomes much higher. And we're seeing that the GCC countries are as impacted as the rest of the world. So there's no real difference this time between different parts of the world. It's really a global, as we've mentioned before, it's really a global kind of phenomena, what we're seeing. I'm not going to go into the full details of this page, but what's worth noting is basically the time to recovery and the difference between the GCC and the rest of the world there, right? So if you look at, when we look at China, it's expected to be the fastest recovery under both scenarios. We're seeing something to going back to recovering to previous growth levels by end of 2021. US, depending on the scenarios, it's 2021 or 2023. I think the GCC, we're seeing that delayed a bit, and that's mainly driven by the dependency of GCC countries on oil prices, and also the scenarios of oil prices, and basically the outlook that oil prices are not potentially improving anytime soon. I can see we're getting some questions. We can table that to the end to the Q&A, but we can bring back the pages when we look at that. But if you have any questions, feel free to put them on the chat, and we'll address them in the Q&A session. And I'll try to be brief in the presentation, as I mentioned before. So all of these scenarios, what does it mean in terms of impact on the impact of this? And we see that there's impact on the consumer that is widely noted, and there's obviously the impact on corporates that we're feeling it on a day-by-day basis. And instead of going through this, I'll take you through some of illustrations or some of the data that's behind this. So the consumers, based on some surveys that we've run in the region, and this is dated, updated, this is towards the second half of April. There is a bit of optimism. So if you look at the confidence level from the consumers in the UAE and KSA, there is optimism that things are going to rebound in 2 to 3 months. I would say maybe over optimism on this level. But if you look at the other parts of the survey, I mean, there's a lot more concern, right? So we see there is strong concern over job security, obviously in the UAE more than Saudi, given the amount of public sector employees in Saudi and the size of the public sector as a percentage of the whole economy. The second question we wanted to highlight is how long can people live off their savings? And the short answer is not long, right? In these economies, we live in a very kind of consumer society, especially in these countries, and there isn't enough savings to support long-term kind of crisis. However, most people are saying, their spending has gone down. It was a surprise to me to see that, there's about 30% of people in the UAE that answered this survey that said their expenses have went up. Not sure how exactly I can explain this, but that was kind of the result of the survey. In addition, there's a clear indication that behaviors are changing, right? Especially in terms of the digital behavior. And we don't expect people after this to go back to normal life, as we say, right? So specifically in banking, what we're seeing in the volumes of online and mobile banking is increasing a lot, and people are expecting that this is going to be something that they will continue to rely on. The penetration in terms of online and digital banking services have increased. And obviously, because of the lockdown, anything that is physical and branch-based and so on have gone down. There's a big psychological barrier for transacting online for a big chunk of the population that we've seen before, and when we kind of worked with banks. I think this has been broken to a large extent, and people have a big chunk of people who had never transacted online before have actually started to do so. And we see this as once you do it, once you've done it once, it's much easier to keep on doing it. And as a behavior, we think people will continue to do it. I think this, looking at it from a corporate perspective, and this showcases the market capitalization and how much different industries have lost from a market perspective and market capitalization perspective globally. I think this is I would take it as a parallel to what we've kind of mentioned before in terms of the impact of this crisis varies between sectors, and it also varies a lot between sectors, right? Within the sector, sorry. So we can see that while there's overall economic impact, and we can see that all industries have been affected for sure. For sure, if you look at travel and oil and gas and some of the more obvious industries, they have been affected a lot more than others. And also within industries, we're seeing a big impact. So some of the works we're doing with some of our banking clients is that really to go into on a micro level on an industry, so that it's not about talking about the retail industry. Now we have to go within the retail industry and understand which ones are brick and mortar, which ones are which ones are online, which ones are online ready, and so on and so forth, to be able to really assess, have a more concrete kind of view of the corporates or of running the business with them. The picture is not very different in the region. So we're seeing also that, from a market cap perspective, there's a big hit, and it's different between different parts of the business or different industries as well.
Maybe can I interject a bit, Hisham, here and add a couple of thoughts. So on the consumer side, let me just talk to consumer and corporate. On the consumer side, in the GCC and the MENA more generally, we're much more optimistic than the rest of the world. But these results are changing on a weekly basis. The new survey that is coming out now shows actually much more pessimism coming. And if you talk to the retailers, so far with 1 week of opening up, there was a surge of discretionary spend, but then that surge stopped around 25 to 35% of normal levels. At the exception of some goods like cars, where there was some pent-up demand, but it's going down. The rest of retail discretionary has really stopped, which means that people are actually still scared to go out. And it's not just the capacity of the malls, but it's actually just simply people coming in, not buying, and so on. So that's kind of on the consumer side. On the corporate side, it's actually quite interesting. So I've had discussions with corporates from Europe, the Middle East, and a bit in Asia. And the discussions literally have changed week after week. 6 weeks ago, people are saying this is a 2-month problem. We just need to max out on our working capital requirement, working capital facilities, and that's it. And it will be fine. Then it became 2 weeks later, it became a 2020 budget problem. Then it became a Q1 problem. Now, with no exception, everybody sees this as a 2022 problem. And a lot of the folks, a lot of the private groups and the large corporates are basically budgeting a market that is 20 to 30% lower than 2019, which was already not great, especially in the Gulf, but outside probably it's a bit better. So they're expecting 20 to 30% less demand in 2021 at least, and that's triggering quite a lot of action. So many of them are putting targets 30% lower fixed cost, a shrinkage of balance sheet to monetize balance sheet, be it liquidating inventory, be it selling assets, be it changing the structure and divesting some of their some businesses. So they want to shrink their balance sheet, and of course they're investing in technology like anyone else. So that's also coming up quite clearly. But also what is interesting is the things that we thought were not possible before are becoming possible. And things like telemedicine, where you see penetration, we're at 0% now, coming to 90% plus in many markets. And e-commerce, where we know the inflection point, typically the inflection point is around 15%. Whenever you get in 15% in buying something, then you stay. We pass those inflection points in weeks. Education, same thing. So while people will go back to normal, I think it's not, we will go back to life and we'll go back to kissing and hugging and so on at some point, but there will be a change in behavior. And literally, I was 5 minutes late because I was with the cable company talking about, we were debating this. I mean, for them, they were able to find, we've been pushing them to cut their costs for 3 years. Within 2 months, they were able to, that they can operate at 40% less fixed cost, 40% less, simply by realizing they don't need as much physical space. A lot of the people actually that they put out just for a short period, actually they don't need them. And so people will realize quite a lot over the last realize quite a lot, and realize more over the next 2 months. So I think we will come out different. Definitely not very different. We'll remain social human beings. We'll continue wanting to see each other, but definitely business models will change, and many industries will be reimagined, in my view, in our view, in this setup. Sorry, please go ahead. Go ahead.
No, thanks, Ahmed. I think that's good kind of putting it together from a consumer and corporate perspective, and it's a good segue to kind of look a bit on the GCC banks. And again, as promised, I'm going to try to run this through 5 minutes so that we keep some time for the discussion with the wider group. So I think if we look at the financial sector in the GCC, similar to other markets and similar to the global impact, together the market has lost about 138 billion in market cap. And again, this is a few weeks old, but the realities are that the loss is really big. Now, if you compare that in a percentage terms to global figures, it's not as bad as what we're seeing globally in the banking sector, right? But still, the banking sector remains the fourth most affected sector globally, and similarly in the GCC, it's the same thing. So it's one of the most impacted sectors. And I think, and we'll get to this later, it's very vulnerable, or it's very dependent on policy makers, and we're seeing new policies being issued on a daily basis, and it's affecting banks immediately. So with that in mind, if you look at the previous crises that hit the GCC, if we look at both the financial crisis and the oil crisis, so 2008, 2009, and 2014-15, different magnitude of impact for sure, but we see on two dimensions, from a revenue perspective and from a risk cost perspective. The dark gray in this page is pre-crisis, and the light gray is post or during the crisis. You can see that the financial sector have lost a lot, for example, in Saudi and during the financial crisis, similarly in the UAE and Kuwait with different magnitudes. However, as we mentioned before, Qatar was not really impacted much during the financial crisis of 2008. The risk cost went up as expected, and similarly during the oil crisis, we've seen the risk cost also go up. However, the impact from a revenue perspective was not as high. So when we look today at the banking industry and the GCC, I think our starting position is a bit stronger, right? So we're showing here a lot of the ratios, and as I promised before, we'll share this with you after the presentation so you can go through it. But across all the ratios, whether from a capital adequacy, whether from a loan to deposit ratios, provision coverage, and so on, we are more prepared as a banking industry than we were during the previous two crises. So that's kind of gives the banks a bit of a buffer than before. However, in a do-nothing scenario, we still see big impact on the banking sector, right? So we're saying revenues could actually drop, for example, in Saudi, anywhere between 17 to 23%. Again, referring back to the two scenarios that we've outlined at the beginning of this discussion. Similarly, the UAE can have a more severe impact of 20 to 28. Kuwait and even Qatar in this instance is a lot more exposed, because everybody is feeling this crisis, as we also discussed earlier. So the revenue growth is going to be impacted more than the oil crisis, and in some instances more than the 2008 crisis. And similarly, the lending growth is gonna also subside. We're still seeing a positive lending growth. Again, some scenarios suggest that we might not see positive lending growth, and we can discuss this maybe in the Q&A, some of the latest things that came out. And when it comes to ratios, we're going to see that banks are going to break through some of the regulatory ratios in some instances, and from a return perspective, we think that the return on average equity and average assets are going to go down, obviously, and core tier 1 capital and so on, CET1 will go down. Right? Most of these are expected. The important things to note is basically what was factored into this analysis, right? So here we're saying that what was factored in is that the government will introduce and have introduced some lending programs and some guarantees that they in these economies. The governments will also, we're expecting the regulators to relax some of the requirements from liquidity ratios and capital ratios, because some banks will suffer. I mean, what we've seen is on an industry average, but within each one of these countries, we know that there's a big spectrum between the top banks and the lower kind of quartile of banks. So we expect the regulators to relax some of their metrics there. And we also thought that potentially there's some repatriation of assets by the government to their own countries to shore up the liquidity and so on in the markets. On the flip side, what can also happen is that the governments can actually look for banks to finance some of their deficit, right? So they can look for some local banks. Essentially, what will happen from this is that they will suck up some of the liquidity that these banks have. The governments, and we're starting to see this more and more, are pushing for the banks to shoulder some of the costs, the economic costs that we're seeing. We've seen this in Kuwait. We're seeing this at a certain extent in Saudi, where the government is asking the banks to, to support corporates and to support even individuals without, an explicit support program from the government. So it's expected that the banks should shoulder some of this. There could be faster deterioration in the asset quality. Again, this is back to what Ahmad has highlighted. What people thought a few weeks ago is completely different than what people are talking about today in terms of expectations of their companies and so on. And the bank's risk appetite is tightening. So how much will banks actually still want to lend to different sectors? And this is in relation to what I mentioned before, that the impact on different sectors is really varied this time. It's not like before. But if banks feel the shock from a risk perspective and decide to lock their balance sheet, the impact on the economy will be much higher. So last kind of thing before I kind of hand over to you and start discussing some of the questions. So in summary, what we're saying is like, look, this is a crisis that is different than what we've seen before. It's something that is it's short and intense shock. It's something that is very much sector specific. We believe the banking sector or the banking industry is better prepared than it was before. And we're coming from a period of modest growth. It's not like when 2008, where we're coming from a period of very high growth. There are structural changes that will come with this. So the consumer habits are changing, as Ahmad has rightfully mentioned, the whole digital and e-commerce and so on. And there are some sectors that will be challenged going forward on the longer term, right? So there are some fundamental changes that will happen from a corporate perspective. And if we look at the impact for the banking industry, I think we need to consider the margin erosion, the risk cost, liquidity, cost pressures on banks. So there's a lot that can happen to the overall banking landscape if it's not addressed head on. How are we seeing banks, or what shall banks, how do they act? There are three kind of horizons to how banks are reacting. The first one is the resolve, and I think we're well past this, which is basically making sure that business continuity is there. I can serve my customers, whether they're retail or corporates. Do they have the right access? Can I provide people the right access to do transactions that they want to do online, and so on? Do my people have the remote access to work from home? How many people do have it, and so on and so forth? And I think a lot of banks have already addressed this lever. The second one is basically the resilience, and knowing that this is not a 2 months situation. How can we actually plan to endure and survive for 12 months or over 12 months? In some cases, this is going to be more of a longer term process. And the third horizon is, look, we're going to emerge from this. How can we actually plan that we emerge stronger? How can we plan to rebuild these our business as banks and as an industry overall? So I think this is what we wanted to share, and I'm sorry that I took longer than I've counted for. But we're happy to kind of go into the Q&A and answer any questions that you might have at this point.
Perfect. There's a question on the chat.
Retail banks.
Sorry, go ahead. Yeah.
No, please go ahead, Jan. Please go ahead.
No, it's fine.
So the question, Hisham, is what can retail banks do in terms of costs under this pressure? I know you've been working with some of them. What exactly
Absolutely.
are you looking at?
Look, so under what we just described before is that retail banks are starting to look at, a lot of the retail banks have had delayed, or some of them had delayed the digital kind of transformations. I think what I mean by this is they don't have an app that is digital. I think all banks have digitized the transaction part of their business, but to a large extent, most banks have not yet digitized their sales journeys. What we're seeing now is that banks have actually started to believe that they also can sell online, and there's a massive push from some of the banks to expedite their digitalization of their sales journeys end to end. And one of the banks that we've actually we finalized board engagement with them in November with a big plan to still roll out a massive branch network, because their board was very adamant that the banking industry needs more branches, and branches are the key driver. This bank, and we're talking about a 4 months, right, 5 months kind of timeline. This same bank has now, has put together a plan of how can we reduce our branch footprint and go completely digital, right? And the implication of this is massive, because if you look at the cost base of a retail bank from FTE perspective, from a premise perspective, from running a branch perspective, just by canceling some branches, the bank was able to finance the next 3 years of a digital transformation end to end, right? So it comes with a savings actually. So they're not building the branches, they're saving a lot of money, and part of these savings are going into building this digital transformation.
So Hisham, this is to your area of expertise on corporate banking. Do we see the same digitization journey with SME and corporate banking? And how do you manage it from a cultural standpoint?
Yeah. Look, this is another discussion that a lot of banks are having. Unfortunately, SME in our markets, or in the GCC mainly, doesn't really get the same focus, because if you look at the size of the pie, it's actually much smaller than everything else, right? So while from a banking perspective, it's not centered to the equation, it's very much something that the banks are actually starting to look at. It's maybe not the top priority, but they are definitely thinking of digitizing the SME journey, because they also think they had this kind of thought that SMEs will never go digital. These are like very traditional businesses and so on. But the reality is SMEs are people running these SMEs. On the personal level, they have gone fully digital. So there's no reason why they won't do it on the SME level. What we're seeing there though is a bit some initiatives that are corporate led with banks, right? So I think there are some initiatives on working capital and how can you digitize invoicing so that you enable some of the government initiatives. I'll take just 1 minute to explain this. So basically, there's a lot of government initiatives in the market to support SMEs, and they've put in a balance sheet behind it, and they've put guarantees and so on. What banks are saying is that all of this is good, but the mechanisms are not clear, and really the typical lending of SMEs don't want money to just, they're not opening new shops, they're not opening new factories, or this is not what they need. The need now, as Ahmed referred to before, is more working capital, right? How can I maintain, these working capital between the different businesses and support these companies? So we're seeing initiatives between corporates and large corporates and banks to support SMEs through invoicing and through early payments through invoices and so on. And this is all through digital platforms.
And there is actually a big push for investment by corporates on these kind of supply chain financing for SMEs.
Absolutely.
Which is something that we're seeing much more. I actually have a question, which is I don't know the answer to, which has the market really priced the risk and the potential NPLs, and for me this is really the big question that we have here, because if you talk to a lot of the shareholders, one of the things I worry about is they actually don't see the risk of NPLs as high. They believe that banks will continue rolling the debt, and they will, so they feel that actually banks are correctly priced now. I don't know the answer, but I think this is something that a lot of the investors are actually asking themselves.
Look, it's tough to answer this on a market level. I can tell you on a bank's level, from the discussions we're having with various banks, is that banks did not have the capability, or some banks did not have the capability to run stress testing on a portfolio level. So banks really focus on individual credit of companies, and now they're developing capabilities to do kind of portfolio stress testing based on different scenarios. When it comes to NPL, I expect that for sure NPLs are going to go up, because banks will roll over debt, but in certain circumstances, when they see deterioration, they're going to ask for collateral to be assigned, and some of the collateral valuations have gone down, whether it's if the collateral is from the market collateral, or depending on what collateral has been assigned. Some collaterals are going down, so the banks are actually reviewing the collaterals that they have on the books, and at the end of the day, banks will have to shore up their books, because they also have massive exposures. So I think NPLs will rise going forward, and from a overall view, I think banks are preparing for this from provisions and so on.
Perfect. Let's see any more questions. So there is a question from Firas. I think in the absence of economic growth, how big is the reliance on corporates and real estate projects on bank loans versus other means of financing? Do you see any trends there?
So basically, the question, will we see a shift into private loans or foreign banks? Look, foreign banks for sure are retracting. This is a global phenomena, or a global kind of view, that a lot of the banks are retracting from secondary markets. So I don't think we will see foreign banks playing big roles in the markets. Private loans, the problem, it's still a nascent market, both from a regulatory perspective and from the platforms that are available. So on a small scale, yes, there are, and they're functional, and we're seeing them through supply chain or through invoice financing and so on. But I don't expect that there's going to be a replacement for the banks. I think the scale is still with the banks. And I think the banks will still have an appetite. The banks just have to update how they look at sectors and so on. So instead of looking at and assessing, do I like this sector or not, they're going to start to look at, within this sector, do I actually like the subsector, right? And on that basis, they're adjusting their risk acceptance criteria and so on.
Can I maybe just answer Firas' question with anecdotal views from what I've seen from the corporates on the corporate side? So on the corporate side, you have the large ones that are very reputable, are able to tap, and actually the international banks are coming to them, and they're saying, just come, they're opening the floods, and they're saying, just take before we get pressure on credit later. So with the relationship that they have, they feel comfortable with these big names. They know that they're going to go on acquisitions or further investments in the future, so they're coming to them. Even the local banks are actually doing the same. So they're all kind of going to the top folks and hunting for them, because frankly, the local banks got support from the government, but they don't know what to do with that liquidity, at least at this stage. It will change maybe in a few months, but at this stage. The challenge is when you're talking about some of the smaller ones, right? If you're a $100 million company, this is where I think the tension is going to be. I think very few players, more broadly, maybe private loans will come, but much more expensive. Other forms of financing will be much more expensive. And the local banks will be wary, especially now that they're going to see the NPLs kind of creeping up over time. But this is anecdotal, and I think we're going to see this coming. Sham, I think there's one more question from Raji, which is,
Hi, Raji.
You've read it, so you can answer it. You can
I read it. I can answer.
Yeah,
So
you can
basically,
just repeat it to the group.
yeah. So basically, the question is whether the banks in the region will act similar. So banks in the region will act similarly to what we're seeing in the West as a means to transmitting the government support to corporates. So I think they will, and this is the only way that the government support can actually reach the corporates, because the government does not have direct relationships with the corporates from when it comes to this, right? They don't have capacity for any direct lending programs. They don't have the capacity to do the assessment and so on. And in the region also, there has been a lot of government initiatives to support corporates before, so that you have, in some countries, the setup already exists, whether it's from a guarantee program or whether it's an indirect lending program. So the infrastructure exists. And this is exactly how the regulators are planning to channel kind of the support. The mechanisms about the support are not super clear to the banks yet, so they're still working out kind of how exactly they're going to apply, and the volumes are not there. So I've actually I check on this regularly with the banks that I cover, and we don't see the volumes from the support packages kind of filtering through to the corporates yet.
Perfect. There was earlier a question about the Chinese figures and how reliable they are.
If you know, tell me. I would love to.
$1 million question.
Yeah, exactly. But look, we have, I mean, what we know, at least for a fact, is from our Chinese colleagues, because we talk to them every week in terms of the activity, and we you know, in terms of industrial activity, it's back, it's fully back. Consumption and so on is not there yet. You know, investments and new capex and so on, it's again still iffy. So frankly, we don't know. I think Raji, you mentioned consolidation. There are already talks about future consolidation. Yes, and it will be expected for sure. I mean, the consolidation started pre-COVID. It will accelerate post-COVID.
Absolutely.
Perfect. Excellent.
Good.
Thank you everyone for
right on time.
Yeah, right on time.
Thank you both very much.
You're welcome.
Thank you guys for having us.
We will share the recording of the webinar as well as the presentation with everybody.
I'll share with you the presentation right away.
Perfect.
Excellent. Thank you.
Perfect.
Perfect.
Thank you. Have a good
Thanks,
day.
everybody. Cheers.
Bye-bye.
Bye-bye.
Bye.